Welcome to FinCorp 360, where finance becomes simple, powerful, and practical.
What if I told you the same thing that grows a business can also destroy it?
Today we're talking about liabilities. In accounting, a liability is a financial obligation arising from a past event that requires future payment. To qualify as a liability, 3 conditions must be met. There must be a past transaction. The company must have a legal obligation. There must be a future outflow of cash, goods, or services. Loans, unpaid wages, and credit purchases are all liabilities. Liabilities are classified into current and non-current. Current liabilities are due within 1 year. Accounts payable is money owed to suppliers.
Wages payable represent unpaid employee salaries.
Taxes payable are amounts owed to the government. When customers pay in advance, it becomes a liability until service is delivered. Non-current liabilities extend beyond 1 year. Materials purchased, what do you think? Accounts payable, tax estimate, what do you think? Income tax payable.
Liabilities directly impact liquidity.
Debt must generate profit. Too much debt can destroy businesses. The debt-to-equity ratio is a key financial metric. It compares total debt to total equity. A higher ratio indicates greater financial leverage and risk. If you're a student, understanding liabilities strengthens your exam performance. If you're a professional, it builds your risk. Thank you for learning with FinCorp 360. Subscribe now and take control of your financial knowledge. Your journey to financial mastery starts today.